Gold, silver, and miners have been on a tear recently. Should you invest or should you stay clear? Let's chat about it. Okay, so today we're going to talk a little bit about gold, silver, and the gold silver miners. As you can imagine, I've been getting a ton of questions on this right now. And with the explosion of both the gold price, silver, and then the miners are having a bang out year, lots of people are wondering, should they have more of their portfolio in gold? And, probably the big reason is it's just on a tear right now. The price of gold has been going crazy. And this is a chart showing you the inflation adjusted price of gold going all the way back to the 1920s. Now, granted, a lot of these years, the price of gold was a steady peg, typically $35 an ounce. But after Nixon took us off the gold standard in 71, you could see the price of gold exploded up. And based on the inflation adjusted figures, this chart says we're approaching the 1980 peak. But the reality is this chart's about 3 weeks old, and we have actually exceeded the 1980 inflation adjusted peak or price of gold. So gold is absolutely, hitting some all-time highs here. And, I always tell, why would you want to have gold in your portfolio? I always have a little bit of gold in my portfolio and in clients' portfolios. One reason, it's a great inflation hedge. Now, this chart is definitely a bit dated. It only goes through 2012, but I just wanted to kind of show how gold serves as an inflation hedge here. So obviously, this chart, when you're looking at the price of gold, it's charted by a gold line. And then you have two inflation numbers. So the red line is it was the official inflation number in the 1970s. And then they adjusted that in the early 1980s. The CPI is calculated different than it was in the 1970s. So the red line after 1980 is provided by a site called Shadow Stats. So they actually track inflation today and through history as it was monitored in the 1970s. Won't get into how it's altered now, but the green line here is the official CPI data. So you can kind of see anytime we've had a pretty decent spike up in inflation, the price of gold has held its own. So it provides you with a very nice inflation hedge over time. This chart kind of shows you also based on the shadow stats and then the official CPI, where gold is relative to the total number of dollars that are out there. So this tracks gold relative to dollars. And you can kind of see based on the official CPI, we are reaching the all-time high that was set in 1980. But if inflation is calculated exactly the same as it was all throughout the 1970s, relative to the dollar, gold still has some room to go before it would reach the 1980 peak. So this just kind of gives you a little different view of it. But another reason to have gold in your portfolio is gold is basically an insurance policy against chaos. Now, this graph isn't really all that great. It's actually from a textbook. I just took a photo. I couldn't really find it online. But what it does is it compares gold relative to a globally diversified 60% stock, 40% bond portfolio. And it's focused mostly when the 60-40 portfolio has drawdowns. And you can see really anytime the 60-40 portfolio has had substantial drawdowns, gold has actually returned a very nice amount to investors. So it does provide some protection when things are going haywire in a traditional portfolio. To kind of stick on this point of gold as insurance for chaos, this chart is kind of comparing 2025 to 2008. So if you look at the bottom of the chart, you can see 2008 when we basically saw gold break out, and then clearly in the 2008-2009 period, gold was doing quite well relative to what the stock market was doing at that time. Now, it doesn't mean that gold didn't have any pullbacks. You can clearly see when you look at the chart, there was a pullback at the end of 2008 into 2009. But you still kind of see a longer term trend that gold provided a very nice hedge and protection against what was going on in the markets. Now, the person who put this graph together is trying to kind of make the point that, look, we're heading for a period where possibly 2025 is looking like the setup of 2008. If you look strictly at the price of gold relative to the US dollar, yeah, those are make for interesting charts, but they don't necessarily mean that that's what's going to happen. So another reason that gold's a good thing to have in your portfolio is it really kind of gives you protection in case the dollar starts to decline. Now, that also is a play on inflation, because typically when the dollar's losing value, you're going to have inflation. It takes more dollars to buy goods and services. But what we can see here is the dollar is finally, it's bumping up against a very long-term trend here, going back to 2011. So if it continues its decline, you could see an issue not only with the dollar, but it gives a tailwind for the price of gold. And really, I don't see a whole lot of good for the dollar right now. Certainly, it could turn around if we had a global recession. Money's probably going to run to the US dollar as it always has. But the reality is, if the normal cycles take place, you can kind of see here, we're starting to head into a negative cycle. And these cycles typically, they last 5 to 10 years, where either the dollar is appreciating relative to other currencies or it's losing value. And right now, it's trending to heading south relative to other currencies. So this should, as I said, provide some sort of tailwind for the price of gold. Another reason you might want to think about having gold in your portfolio is the central banks are hoarding gold right now. This is the first time in a long time that gold is a larger percentage of foreign reserves for central banks than U.S. treasuries. So we haven't had that situation since the mid-90s. So there's definitely something going on here. And if this trend continues, again, there should be some sort of tailwind for the price of gold. Just giving you an example of China's central bank, they have definitely been loading up on gold. They started it way back in 2009 when the Federal Reserve here in the United States really started printing and conducting quantitative easing, but it's been escalating considerably over time. One interesting thing is Jeff Gundlach, who founded Double Line Mutual Funds. He's actually recommending maybe up to a quarter of your portfolio in gold. Now that's pretty excessive, but this is a bond fund manager recommending that much into gold. So somebody who earns their money investing clients' assets in bonds, you think that he would spin a story to say you should have more money in bonds, but he's recommending 25% in the precious metals. And he's one of the smartest guys on Wall Street. So I always take note when some of the smartest guys in the investment world are recommending something. Now, clearly there's some tailwinds for gold, as we've discussed here, but right now, gold it's so hot that it's really overbought in the short term. And the way you measure that is something called the relative strength indicator. And it looks at the total number of call options being bought and the number of put options being bought. And typically you want to see, within a, say, 70 to 30 RSI, that's kind of a normal market. If it gets below 30, then it's really oversold. But if it gets above 70 or 75, then it's really overbought, meaning there's too much money buying the precious metal right now, or any holding that has that high of an RSI. So I wouldn't be surprised in the near term to see a pullback in gold, just at least until we get to a more normal situation on the trading. But it's really hot right now, and it's really being bought by investors. Now, another thing you may want to think about is silver. So this is a chart comparing the price of gold to a price of silver in ounce. And you can kind of see, while we're not at all-time highs, we're still awfully high relative to historical norms. Really the historical average has been about 60 with the price of gold to silver. And right now we're well above 80 right now. So a lot of people look at this and say, well, silver has some catching up to do to gold. So if you're looking at investing some dollars in precious metals, you might be better off adding a little bit extra to silver relative to gold. Another thing, when you look historically, silver right now is trading at historical lows relative to U.S. equities. So while everything in investing is cyclical, as everything in life, that also holds true for silver and other asset classes. And so right now, this chart kind of tells you that either silver is going to appreciate considerably relative to the S&P 500, or we could have the S&P 500 decline quite a bit relative to the price of silver, or a combination of both. Now, along with gold, silver is experiencing a very sizable breakout. Now, the thing is, it's also experiencing a lot of momentum with investors. So the relative strength indicator for silver is north of that 70 figure right now that we'd like to see. So again, even if you think that silver's got some tailwinds because of its price relative to gold and price relative to the stock market, right now you could see a pullback just based off the relative strength indicator. So if things normalize a little bit, we get back into a more normal trading range as far as number of calls being bought and number of puts being bought, you could see after this pullback a reemergence of silver yet again. So if you like the price of gold and you like the price of silver, and you think there's some, there's some historical strength being shown here, some cyclical strength, well, you might want to look at the gold miners or silver miners. The mining industry has been on a tear recently. So this is a chart showing you all of the different sectors of the S&P 500 for 2025. And gold miners have outperformed every other sector of the market, and it's done so sizably. Yet, the price of gold miners relative to the price of gold is still at kind of a not a historical low, but a low. It's well below the historical average. So if you look at it that way, you could say that there's still some room for the miners to run relative to the price of gold. So despite this year's outperformance of gold miners, we could still possibly see some tailwind for the gold miners. And this is especially true considering the fact that the total amount of global equities, the percentage of mining stocks of the total global equity market, is at a historical low. Only about 1% of miners make up, or they only make up 1% of the global equities around the world. So that's very low. Now, I don't think we'll ever get back to the point where we see 9, 10, 11%. This was way back in the 60s and 70s. But even if we were to get back to, say, 2%, that means that relative to the global equity market, miners would have to double in size, or the rest of the global stock markets pull back to get them back to 2%. So there could be, again, another tailwind just based on some sort of historical averages here. This is a chart showing you one of the oldest mining companies, Barrick Mining. And what you can kind of see here is way back in the 80s, it had a historic run when gold was doing so well. And then really from about, I guess, 91 up until recently, it's been very range bound. It's certainly been volatile, but it's kind of been stuck in a range, as you can see here. But right now, it seems to be breaking out of its long-term pattern. That doesn't necessarily mean a whole lot, but if you're a chartist in any way, you might look at this and say, well, it's something to definitely keep my eye on. Some people might say we don't want it to really focus on it until it gets to the peak within this range, which would have been probably the 2011 peak. But it's certainly something that's interesting and you might want to think about. The same kind of goes for silver miners. We're starting to see them break out of a long-term range here. Again, it doesn't necessarily mean it's going to continue. It could pull back from here. But when you see long-term ranges like this being broken, as an investor, you really need to take notice. This is just a chart showing you the largest silver miner here in the United States, Hecla. And it too is definitely breaking out of a long-term trend here, going all the way back to 1980. So if that continued, and if we see silver do what gold's doing as far as surpassing the 1980 peak, you could see some serious tailwinds for silver miners. And the other big reason that you have to start to like miners isn't just that they're maybe cheap relative to the price of the underlying precious metal, whether it be gold or silver, but there's some real financial support here for miners. Now, the first one is just the fact of the price of gold relative to what it costs to mine gold. So right now, if gold's trading, this chart at the time is gold was at 3,500. Right now, it's pushing right up to 4,000, and it's basically costing a gold miner about $1,500 to pull an ounce of gold out. So if you can produce your product for $1,500 and then sell it for $3,500 or even up to $4,000, that's an enormous margin right there for any company. That's a margin that should get you excited as an investor. And when you look at this chart historically, we're at a period where they're experiencing extreme profit margins. Right now, you're looking at gold miners having roughly about a $2,250 margin on every ounce of gold they pull out of the ground. That is a time that's just a time to be invested in miners. I mean, they're basically printing money at this point. So if they're making over $2,000 an ounce in profit on this, that's fantastic for them. And the other thing is, just as companies overall, miners have become more mature. Back in all the way to 70s, 80s, 90s, even into the early 2000s, miners were kind of seen as, the outlaws of the investment world. They were kind of shoddily run, highly unreliable. Their companies were operating in countries that are extremely unreliable and politically chaotic. So they were wildcats, if you will. And that's kind of changing. And you sort of see here some of the gold and silver miners, they're not adding on as much debt as they used to. So they're managing their debt load very well. They're also not issuing a lot of new stock or new equity. So the companies are now managing their debt and equity very well, almost like a regular big boy companies now. And their cash flow, of course, as we're talking about, is at all-time highs. And this chart's a little bit dated. This was actually from the end of 2021. And you can see 73% of gold and silver miners were producing positive free cash flow then. It's only getting better now due to the price of gold and silver. So that number could be north of 80%. This is also a little bit dated, but it's just showing you the median free cash flow margin for companies. So that not only they're experiencing free cash flow, but they're actually seeing it in a large percentage. And with the price of gold and silver hitting highs, and that profit margin per ounce of gold or silver also doing well, I would expect that you'd see their cash flow percentages continue to climb even higher. So these are operating like very mature companies right now. Another thing that's kind of a nice tailwind for miners is the fact that the price of oil has kind of been, struggling a little bit here recently. So if you look at the gold to the price of oil ratio and silver to oil ratio, both of those are not at all-time highs, but they're awfully high. The only high that beat it was the year 2000 when COVID hit and the price of oil dropped to negative per barrel. But outside that, we are now experiencing all-time highs there. So what does this chart really mean? Well, it says that one of the biggest inputs for miners as far as their cost is oil. And if the price of oil is dropping relative to the product they produce, whether it be gold or silver, then that means that they're going to experience even higher profit and profit margins. Now, just like gold and silver, miners are overbought in the short term. So when you look at the RSI, it's well above 70, and this one's pushing close to 80 right now. So it's actually the most overbought RSI for miners of all time. So we'll see what happens. Does this mean that miners are peaking at this point? Because every time we've hit a top figure in the RSI for miners, it did mark a peak in the price for miners. So that is something to remember here when you think about adding some money to some miners. What you could think about doing is wait until the RSI pulls back a little bit, meaning that the price action takes a little breather too. Maybe that's a good entry point to come into the miners, but you have to watch it because miners are historically extremely volatile. It's probably the most volatile section, even though they're now acting more like mature companies. It's still a very volatile holding. So something you need to think about if you're going to invest in the miners. And this is also kind of interesting. All of the stuff I've talked about, the RSI is high. There's huge, backdrop for miners with the price of gold and silver and them acting as more mature companies. But yet there is a lot of money leaving miners right now. So there's a lot more sellers than there are buyers, despite the fact that the RSI is high. So a lot of interesting stuff with gold, silver, and the miners. But I get so many questions on this from clients. I thought I'd just do a quick little video to try to get some information out there on it. Now, again, I always leave it with our little lawyer say hi here, our disclaimer, and we'll finish the video with a disclaimer as well. But, it's something to think about with the price of gold and silver hitting these all-time highs. How should you allocate it? Is it too far gone, or is there still room left? But it's definitely an investing trend to be looking at as an investor.
Saving Yourself from Wall Street is hosted by Kirk Kinder, Certified Financial Planner. He is the Director of Financial Planning at Bastion Fiduciary LLC, an independent fee-only financial planning firm. Bastion Fiduciary LLC is regulated by the SEC in accordance and in compliance with securities laws and regulations. Kirk Kinder and Bastion Fiduciary LLC does not render or offer to render personalized financial, investing, or tax advice through the Saving Yourself from Wall Street properties. Information provided is for informational purposes only and does not constitute financial, investing, tax, or legal advice.